Powell gets confirmed for a second term as Fed chair. Equity vol starts to pick up post options expiry. Europe re-enters lockdowns and oil prices fall as geopolitical theatre ensues. All this and more in this week's Macro Insight. So, welcome back to Macro Insight, everyone. Today is the 23rd of November. Let's take a look at these markets. So, what happened last week? Big tech obviously was up again. So you had Apple, Nvidia, and Tesla again leading the way, as has been the case for a while. And then euro dollar, on the other hand, was the hardest hit, which was off by about 2 standard deviations, right? So what did we have? We had 2-year rates in Norway, German 10-year, Swiss 10-year. Those are the things that were kind of the heaviest down, along with the euro. Apple had an over 2 sigma move to the upside. New Zealand rates, Nat gas was up as well. Obviously, that had a bit of a tough time yesterday. But those big techs, Amazon was also up there as well, up over 1 standard deviation. Now, the big move that we'd all been waiting for was obviously the news on Powell getting confirmed as the Fed chair for another term. And, you know, markets have been a little bit nervous and on edge about that. So the market in general took that as quite hawkish. So, you know, he was kind of judged as the more hawkish, who was going to really get inflation in check. She was going to be looked at as a bit more dovish, but to be honest, I'm not convinced they were going to be that different. So you saw here, if we look at the right-hand chart, this is just showing you kind of boxed what happened on the actual Powell news, and they all spiked, but it kind of shows you up to each date, the June 22, Sep 22, and December 22, how many hikes are being priced in. So we've pretty much got a full hike priced in by June. We've got nearly 2 by September and 2.77 by December in terms of what's being the probability of hikes for next year. If we look at the chart on the left, that compares the market's pricing, which is the pink one, that compares that to the dot plot. And you can see that the dot plot is just nowhere near. Yeah. So the market is clearly pricing that the Fed is miles behind the curve. They're going to have to massively increase or accelerate the pace of hikes to get this inflation under control. Yeah. Now, sort of following on from that and countering the transitory narrative, right? So that if the Fed dot plot is right, it's basically because they turn out to be right on the transitory call, and things do calm down, right? The cure to higher prices is higher prices, and we start to see things calm down by middle of next year, right? That's kind of what he said as his kind of timeline for it being transitory. Now, countering that narrative, Bridgewater put out a pretty detailed report. And basically what they're saying is that this is not supply side led inflation. Right, so the big kind of argument around why this is all transitory is because, yeah, you had a bit of a demand boost, but the supply shocks are really the big problem. They're going to go away and things are going to calm down. And Bridgewater have done a detailed piece, and I'll put the link in the report, but basically they're saying, no, this is actually all demand led, right? And you can see that by looking at the data. So if you look at this chart here, so Europe's back into lockdown, showing, you know, the Austria data. So Austria cases kind of at an all-time high. Hospitalizations are above the UK and the US. And if you look here, Austria, I mean, compared to a lot of other countries in Europe, I mean, Eastern Europe's having a nightmare on the hospitalizations front, right? Austria, you know, you could argue doesn't look as bad, but they've gone with pretty strict lockdown measures. They've also made vaccinations compulsory from February next year. So we'll see what happens there, but they're saying they're going to be fining people who aren't getting vaccinated and stuff like that. And then Germany is also talking about, imposing a lockdown as well and saying this situation is as bad as it's ever been. All right. So this kind of resurgence of COVID in Europe has really been the driver behind the recent weakness in Europe, basically. So let me find this chart. Here it is. So you can see here various things, various sort of market pricing of Europe. So you've obviously got Germany, same story. That chart on the top left, German cases as high as they've ever been since it all began. So you've got the euro crosses, all the euro crosses there just trending lower and lower throughout the last month, okay, getting dragged down. So broad-based euro weakness. You've got the Euro stocks versus the VIX. You've got the Europe VIX versus the regular VIX. You're seeing more stress being priced into the European volatility curve in short-dated options. And then I flagged last week that kind of SXTP, which is a travel and leisure sector in Europe, had been relatively underperforming and was kind of showing you where things were headed on the COVID front. And that's kind of continued to roll over. And if you kind of superimpose a chart of the euro against that, you can see in that latest sort of down impulse, it's kind of taken the euro with it, basically, right? So these are all things that, these are kind of the reasons why Europe's a bit of a mess at the moment, okay? If we look back to the equity markets in the US and what's been happening over the last week, well, obviously we had flagged the kind of big pin on the S&P around 4,700 going into November expiry. Turned out to be a very, very strong pin. Market gravitated, as you can see, around that for pretty much the whole week. The vertical dotted line shows you the time of expiry, and then you can just see over the weekend, we've come, obviously we had a bit of news out on Powell, but net, the market was probably at the margin still thinking that was the base case. But look how much more volatile we've become after the release of that pin, right? I could extend that even further, right? And it's just compared to all the volatility we saw over the previous week, we've done a whole lot more just in 24 hours, right? Since the expiry of that pin. Now that OPEX is out the way, obviously, and the gamma is kind of gone, we've had this kind of unpinning, right, of the market. So if we bring up this one. So this unpinning of the market and the fact that implied volatility is kind of staying elevated, what could be the reasons for this? And I've called it warning flags, right? So the kind of way I would read it is, well, we've had cross-asset volatility spiking. So the top left chart, we've got MOVE index, which is the rates vol. We know that's been elevated for a while. We've been flagging it over previous weeks. Now, FX vol has joined the party, right? So you see Euro-dollar 1 month vol has spiked as well from the lows. It was at the lows of the year and it spiked quite significantly. And yet equity vol has just stayed suppressed, okay? So you can understand that we've had very low realized vol. Now that pin has gone away, does that kind of then free up the market to start moving again? And as equities maybe does realize more, does equity vol catch up to some of the cross-asset vol? Okay, so that's one potential reason why implies might stay firm. Now the spot up, vol up dynamic that we've been seeing on NASDAQ. So as we see that rip higher in NASDAQ to the top of the channel, you've seen the Vixen also be quite firm. We often see those episodes of vol up and spot up before a bit of a reversal. Now, could yesterday be the start of that? Maybe. There was a bearish engulfing candle yesterday, a big reversal day where we made new highs and then we finished down on the day. That's quite bearish generally in terms of price action. That may well be the start of something, but the vol up, spot up often does give you a bit of a lead on that type of reversal, basically. Right? So this definitely something to be careful about, I would say. Obviously, puts have been a bit out of fashion. Not a great indicator generally, but just a sign that there's probably some incremental hedging that needs to be done if this does start to turn into a sell-off because people aren't loaded up on puts. So you don't expect that the first dip, you're going to see loads of put sellers who are monetizing, because puts have generally been out of fashion, and the put to call ratio showing that. So another kind of warning flag there. And then lastly, we've got obviously spot gamma's gamma landscape, which post expiry is now showing us, whilst we've got you know, a large amount of long gamma and call wall around the 47.50 area, as we trade down, it's quite steep, that profile, right? So you lose that gamma pretty quickly, and below 46.70 you go negative gamma, and then you don't really get to the put wall where they have their maximum amount of put gamma. You don't get there until 4,400. So what that kind of says to you is that there's a bit of a vacuum where people aren't really that well hedged. There's not been loads of put buying activity, and so past the vol trigger where the street doesn't own any vol, you might then suddenly see a load of clients want to buy puts. The street gets taken and the street gets taken even shorter vol. And then you can see a bit of acceleration and a bit of a VIX spike, basically, right? And that would kind of take the VIX more in line with what some of the other asset class volatilities are doing. Yeah. So definitely some fragility there, definitely something to kind of be careful of, right? Now, if you wanted to buy the dip, you know, maybe it's a bit premature. You kind of want to see us bounce off these levels and stabilize, and maybe VIX come in a bit. But if you wanted to buy the dip, then, you know, you've got to use calls and call spreads, really, right? Probably call spreads, because vol's not screaming cheap. So, you know, call spreads and things that you like, and maybe slightly longer dated ones are probably the more sensible way to be dipping your toes in for any buy the dip type opportunities. Yeah. So oil, what's going on in oil? Speculative money moving out of oil and into gold, right? So yeah, quite a lot going on in commodities. Obviously, we had that little breakout in gold last week. And what that did is that triggered a bit of a move of spec money into gold, right? So we've seen, if we look at these charts, they kind of show you crude oil, Brent crude oil positioning to manage money. That's been rolling over. That's at the year lows. Whereas if you look at the gold paper position, so like ETF holdings, things like that, what hedge funds are doing, that's had a big spike, right? So general speculative money moving away from oil and into gold, right? Now, why move out of oil? Well, we've obviously seen the rise in COVID cases has impacted European mobility, and that if that then filters over to the likes of the US, which are a couple of months behind Europe a lot of the time in terms of the virus, you know, what's that going to do to travel, etc. So bit of concerns there on the demand side for oil. But then also the big thing is Joe Biden, right? He's asked China, India, South Korea, Japan to all, you know, do SPR reserve releases, you know, that a coordinated release of their oil stocks to bring gasoline prices down. And he's just using his political sway there with his allies to try and, you know, stick it to OPEC and say, you know, we can do this and bring prices back down. But the problem he's got is that OPEC can counterstrike that, basically, right? If they release too much, and, you know, Japan and India and that have said that they will release some, but they've got various restrictions about how much they can release. OPEC can just counter that, right, and do something on the supply side. So whereas it has knocked a few dollars off the oil price, I think now that the news is out and it's been confirmed, that may well be a, you know, sell the rumor, buy the fact type thing now, right? And we're kind of seeing that if we go to what the oil price is doing, it's kind of having a little bit of a bounce off the intraday lows after it was announced earlier today. Right, so I mean, we had this level. I've got some support levels drawn up on oil, and we've been hovering around this kind of 75 and a half level. If broken, we may have got an overshoot towards 70 around this 200-day moving average. Looks like for now, though, we're holding, given that we've had the SPR news out just today, this morning, that's relatively constructive. So dipping your toes back into oil, we've got a bit of a bullish divergence there as well on the momentum indicator. Now that big kind of political issue is out, it could well be a time to dip your toes back into that, right? If you're worried about what's going on with Russia and Ukraine, and if that's going to trigger some volatility, obviously, you know, we're talking about them kind of getting ready to invade and things like that. then maybe calls and call spreads in oil is a better way to play it if you're a bit worried about what could happen. But if you're okay just holding on to these positions for a longer period of time and accumulating commodities on dips, like we've kind of has been a theme for us, we've been talking about, then I don't think it's a bad time to start dipping back into this trade. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.